Right, it's exactly 1 o'clock. Let's get going with the session. So yesterday we spoke about basic technical analysis, and we looked at a couple of things that is important for you to look at and to take into consideration when doing a technical analysis. And we all know that doing the technical analysis is all part of getting our timing right, because we know that timing is one of the key things that a lot of beginner investors and also intermediate investors struggle with, trying to get the right time to get into the stock. It's normally the main problem. Now this afternoon we're going to look at a little bit at about trend lines and formations, and I'm going to show you a few formations, and you should see that on your screen right now. We've got the first share up there, but before we start looking at some examples this afternoon, I first want to talk a little bit about trend lines and formations. Now, we tend to find that within shares there are certain patterns that tend to emerge if we study the chart long enough. It is important for each investor or trader to understand that a proper technical analysis of a share is pertinent to the success of your timing and decision. Now, I want to reiterate this by saying that you need to study the charts long enough in order to find the right position to get into the stock. We see this a lot of people only look at the last month or the last week's data in order to make a decision of whether or not to buy into a share. But if you don't look at the long-term perspective of the share, you don't really have an idea of where the share comes from. And yesterday we said this as well. We say this a lot in all our technical analysis webinars, that you need to make sure that you look at the almost the whole time frame of a share, but on a minimum basis at least 2 to 5 years worth of data in order to make a decision of whether or not it's the right time to get into the stock. And the reason we said that was because we want to look at the underlying trend within a particular share. We want to look at the moving averages, right? Is it in a bull trend? Is it in a bear trend? Or is it ultimately moving sideways? Now, all of these things play an important role in deciding whether or not you want to buy the share. So I want to tell you this afternoon again, do not fall into the habit of only looking at the past 2 months or the past week or the past 6 months data. My apologies. But look at the overall picture. Look at the overall picture of what's happening with a particular share. And as I said, look at a minimum period of 2 years, but adjust that to approximately a 5-year period. Especially those shares that you tend to find show you sort of downwards channel formations that's been in a downward spiral for the past 3 years or so. Rather zoom out and see the reason behind this share plummeting. A lot of the times we get that good quality stocks tend to rally for 5 or 6 years, 7 years, they tend to go up. But at a certain point in time, that share probably needs to start to come down. And normally what will happen is that share will basically start to retrace by 50% of the value that it gave. So these are things that you need to bear in mind. Now, when we talk about technical analysis, I first want to look at the definition of a technical analysis. Now, this technical analysis definition you can go and find in our glossary. And on our website, I want to encourage you to make use of the share tracking glossary. That's basically like a glorified dictionary where you can go and find all stock market terminology in there. If you want some examples or want to study up on a word that you don't know about or that you hear them talking about, I want to encourage you to make use of the glossary. But also I want to encourage you to make use of the lecture material. I said this yesterday as well. The key to success in the stock market is knowledge. Now, you can study charts long enough, but if you don't gain any knowledge from whatever you're studying, it will not work. Now, ultimately, in order for you to make a success, you're going to need to study some of the stock market terminologies. You're also going to need to work through some lecture modules, read up on the markets, whichever the case may be. But let's look at the definition of technical analysis. So the term that we're looking at is technical analysis. Now, in our definition, we say that it's a school of investment. Technical analysis is a school of investment, assessment, and the thought which maintains that there are certain patterns present in the price and volume charts of the particular stocks. And these movements or certain patterns that emerge from certain stocks can be exploited to improve the investor's probability of making the correct investment decision. So it's all about getting our timing right. That's why we say that technical analysis is equal to timing. It's all about timing. Now, if we go a little bit deeper and we look at it a little bit deeper into technical analysis, we see that there are three types of charting or technical analysis things that we need to bear in mind. The first thing is formations. Now, when we talk about formations and when we use the phrase formations, we say that formations are things such as your head and shoulders patterns, your reverse head and shoulders patterns, double tops, double bottoms, pennants, flags, wedges, channels. These things are formations which can be discerned when looking at a chart. Now, some of these formations that form have been associated with a high probability of one move in one direction or another. Now, when we talk about a move in a certain direction, we normally talk about breakouts that happen at a particular point. So when you look at a wedge, you'll see the chart that is currently shown to you on your screen. You'll see there's a chart on your screen that you can look at, and you'll clearly see that this company, S&H, right, that there's been a breakout. You'll see there's a sideways pattern, and then there's a strong breakout that occurred above that resistance level, and then it rallied ultimately to go and make a new high. Now, all of these things ultimately play into us making a decision of whether or not it's the right time to buy the share, because we know for a fact that we want to wait. If a share is in a sideways pattern or a sideways formation, we will wait for the share to break above its resistance level quite strongly before we will initiate any sort of buy. Otherwise, we're expecting the share to continue to move sideways, right? And this is just one of the things that we're going to look at, and there's other formations as well that I'm going to show you some examples of that you can look at. But if we look at the second thing of technical analysis, so we said the first thing, the first type of technical analysis that we talk about is formations. The second thing that we talk about is called line indicators. Now, line indicators, the simplest line indicator or simplest line chart is the closing price, right? And this is exactly what you're seeing on your screen right now. That's that black line moving up and downwards. That line is associated with all the closing prices of this particular chart. But you need to understand that there are hundreds of formulas which have been developed. Things like the stochastic oscillator, the momentum indicator, the overbought, oversold indicator, the MACD, the relative strength index, or things like the RSI like we know it as. These are all line charts. Now, line charts are very often have trend lines or moving averages, Bollinger Bands, or other tools or line studies that are superimposed onto them with a certain interpretation. Now, yesterday when we did look at a basic technical analysis, we actually looked at the MACD graph and we looked at the stochastic oscillator, and we said that where there is certain crossover patterns happening on the chart, we're expecting either a buy or a sell signal or a hold signal within that particular stock. And that's exactly what we talk about when we look at line indicators. But then there's a third thing when we talk about technical analysis, a third factor, and we normally refer to this as the wave and cycle theories, and we spoke a little bit about the wave and cycle theories when we did the technical analysis modules a while back. And we said that there are many theories that have been developed to account for the apparent cyclical movements within the markets. These theories are things like the Elliott wave, the Kondratiev wave, the Gann theory, and there's many other theories out there which I don't want to bore you with this afternoon. But these theories play an important role because we do look at the cycles that occur within a particular stock. We take that into consideration. Once again, in yesterday's webinar, we spoke about looking at the cycle of a particular stock, buying at the right time, getting in when it's cheap. So we do note that there are certain cycles that do occur within stocks. Now, I get this question a lot, and people ask me, okay, but if we do a basic technical analysis by just looking at the basic things, why is it important for me to identify certain trends or certain formations that do occur within shares? Now, the reason we do that is because it helps us to identify the trend, exactly what it says. It's looking at the trend lines and looking at formations that occur. But what we ultimately want to search for is the trend. I'm trying to figure out if my share is in a bull trend, in a bear trend, is it moving sideways? Is there an increase or a decrease in momentum? Is the volume picking up? All of these things play an important role, and you obviously want to go and look at those things. Now, the second reason why we want to look at trend lines and formations is because we want to confirm what we're looking at. We just said we use line indicators, and the line indicators we use are things like the MACD and the stochastic, right? Now, these things we use to confirm what we are seeing on the chart. And obviously, the third important part about trend lines and formations is to try and figure out if it's the right time to buy the shares. Timing is the important role about technical analysis. You want to try and get it as close as possible to being correct. Now, there's another word that you will probably hear us talk a lot about in our lecture material and also in our webinars, and that's the word validation. Now, when we talk about validation, one needs to understand that for a trend line to be applicable, you need to connect two or more high or low points. Now, I've done this example with you. You'll see on the chart that's in front of you, you'll see that my support line, which is the bottom line over here, it touches this line at least 4 times, right? You'll see 1, 2, 3, 4 times, right? You can even count that one as well, which is the 5th time that it touches that line. But when we talk about validation, we say that the good rule of thumb is it takes 2 points to draw a trend line. Obviously, you can't draw a line, a trend line, without it touching at least 2 points, right? Now, the 3rd time something touches that line, then you know that that point has officially now confirmed the trend. Then you know it's moving sideways, or you know it's moving upwards, whichever the case may be. Now, let's look at a few examples this afternoon of things that we can focus on to get an idea for what we should be looking for and how it works, right? Now, for those of you making notes, there are different trend lines and formation types which are included. Now, some of them are, as I mentioned in the beginning part of this webinar, bull trends, bear trends. Now, the way you indicate that is by the use of your moving average. You'll see I've got a moving average line on here. Remember, you can go and find your moving average line if you go to your studies. You'll see I've got my moving average line, and it's showing me either a bull trend or where the share is moving into a bearish phase, right? The bear trend. Then you'll see you get things like breakouts, and I'm going to show you examples just now. I've got the example in front of you. You can see some breakouts. Then you get things what we call channels. Then you get double tops, double bottoms, head and shoulder patterns, reverse head and shoulder patterns, V tops, V bottoms, saucer tops and saucer bottoms, triangles, wedges, and pennants and flags. There are a bunch of these things that you can go and look at. Now, I've just mentioned a few of them. Now, I know a lot of you are telling me, Corneille, whoa, whoa, whoa. I'm struggling to make notes because you're saying all of those words too quickly. Well, I want to tell you, you don't have to fear. If you go to the lecture material, right, go to the technical section of the lecture material, and please go and read the lecture module on trend lines and formations. So we've got a whole lecture on it, and I'm going to touch on it. This is exactly why we have the webinar this afternoon. But please do go and read up. Do some self-study and go and read lecture, the 4th lecture, which is trend lines and formations, under the technical section of the lecture material. Now, this is the first stock that I want to talk about this afternoon. You'll see that SNH in 2011, it moved into a sideways pattern. Remember, we just said in order for you to draw a support line or a resistance line, there needs to be at least 2 touching points. And remember, by the time it touches that line for the 3rd time, you now know that that line is then confirmed. Now, you'll clearly see here that this company went into a sideways pattern, which lasted for a few years, actually, since 2011 up until just before the end of 2013. Now, you'll notice that in 2013, on the 3rd of September 2013, there was a breakout. Now, there was a very strong breakout, and this is why I say strong breakout. There was a break above this resistance level, and the share rallied. Now the idea behind a sideways pattern is that the longer the share moves in a sideways pattern, the stronger the breakout we are expecting. But that can only occur if the share prices breaks through this resistance level very strongly and moves upwards. But not only should it break above this resistance level strongly, it should also close. Its closing price should be above this previous resistance. Then we know the share is now rallying, and this is exactly what happened to the stock. And since that breakout, if you did do a technical analysis and you did catch that, you'll see that the overall growth was about 222% since the day it broke above that specific level. So 222% worth of growth. Now you can clearly see the share is busy moving in a downwards pattern again, but what is quite interesting is what is emerging on the right hand side of your screen. You'll see here where I'm pointing for you. You'll notice that the share prices are now moving in a sideways pattern once again. Now this is really interesting, because this means that if the share price does not break below this level, and this level is approximately 62, 63 Rand for the share. If the share price struggles to go below that value and continues to move between 63 Rand a share all the way up to about 74 Rand a share, and it continues to move sideways, then we know for a fact that the longer this sideways pattern is going to continue, the stronger breakout we're expecting, right? So if the share breaks above this resistance level, which is at about 74 Rand per share, then I'm expecting the share to rally quite substantially like it did in the previous one. So this is something that one would look for, is these sideways patterns and these breakouts. And this is why it's so important to study the history of the chart to know what you can expect for the future. Now the next thing that we want to look at is what we call a V bottom or a V top. The example that I'm going to show you is Kumba, it's KIO, which is a really good strong example of a V bottom. You'll clearly see the V bottom being formed here. The share prices continues to drop down dramatically and turn on the same spot and start to move up. This is what we refer to as a V bottom. It also forms the V and it bottoms out here at the bottom, and this is why we refer to this as our V bottom. Now V bottoms are normally associated with very strong upwards movements. This is V bottom, strong upwards movements after the share price turned on almost on the spot. It turned around. Now this can be because of a numerous amount of things. It can be because the company made an acquisition, the company had very good financial statements, or the markets are pulling up, resource prices are much higher, which means the companies are benefiting from this and investors are reacting to that news. But a V bottom is always associated with a sharp turnaround in share prices. This is then referred to as a V bottom. Now also on Kumba's, you'll see on Kumba's share prices here, you'll see we get what we refer to as a saucer top. We spoke a little bit about saucer tops and saucer bottoms. Now this is what we refer to as a saucer top. Now saucer top means that the share price, it comes from a dramatic incline in share price, but then it starts to lose steam, right? And it starts to move in sort of a sideways pattern, and then the share price starts to fade off as it continues to move down. Now this is a really good example of a saucer top. We can clearly see share prices starting to lose steam. It's making smaller highs, and as it's making these lower highs, right, and it's topping out, we see the share price turning around, starting to fall. And we then refer to this as a saucer top formation. Now, if we see the saucer top occurring, we can expect share prices to continue to move further downwards, right? Now, the inverse of this would obviously then be a saucer bottom. It's exactly the same pattern, except it is the inverse. So the share price would bottom out and then ever so slightly start to move up. So this is a good example of a saucer top. The next thing that we want to talk about is resilient, RES, and you'll see we've got what we refer to as a double top. Now this is something that you would probably see a lot on your platform when looking at shares and things like that. You will normally notice these double tops, or even I see a lot of the stocks now these days, they like to form triple tops and triple bottoms. And these are very important points and key marks to look at, because the fact is that the share price is struggling to go above a certain price level. Now, normally, if a double top or a double top or a triple top is formed, this is normally a good indication of a downward trend which is to follow. So if there's a double top, even if it's a triple top, if it's a triple top, then it's a very strong level, which then means that the share prices will start to retrace back and we'll see a decline in share prices. The same goes for the inverse when we talk about a double bottom or a double top, a double bottom or a triple bottom. If there is a strong triple bottom, it means that there's a strong support at that specific level, whichever it might be, and the triple bottom or the double bottom would then signal a strong upwards movement in share prices, which is to follow. So that's always a really good indication to look forward to. So if you were invested in resilient and you saw this double top forming, this will already give me red lights, giving me an idea that the share prices is going to pull back, and that basically did happen in the share price. Now the next thing that we can look at on this shares is Mondi, MND, and you can clearly see I've marked this out to you. The share price basically went up dramatically, so there was a great incline since 2008 in the share prices, but then all of a sudden the share price in 2014 moved in a sideways pattern. You'll see that I've marked it there for you. The sideways pattern lasted for about a year, which was then followed by a strong breakout above this resistance level, and it rallied to make a new high. And this is why I say it's so important to look at the history of the chart, because the history will tell you what you can expect. Once again, the share prices made the same sort of movement like it did in 2014, and it moved in a sideways pattern for about a year and a little bit more than a year, about a year and a month, a year and 2 months. It moved in a sideways pattern. It broke above that resistance level, and the breakout is basically occurring now, so I'm expecting share prices to continue to make new highs. Now, if you did watch Mondi share prices, you would have caught onto this, and you would have noticed that this sideways pattern was the same sort of sideways pattern that we saw that emerged from the stock in 2014. Once again, very good example of why it's so important to watch the history of the chart, because the history normally tends to repeat itself within a particular stock. Now, the next one that you can look, I want to show you on Sasol. This is something that a lot of you are watching, and I know a lot of clients are invested in Sasol. You'll see Sasol once again, always a good example for a buying position and a selling position. You'll see here since 2015, Sasol share price is moving between the level of about 360 Rand per share up to a maximum amount of about 490 Rand per share. Now, what's quite interesting about this sideways pattern is that people can actually make a good amount of money from this. Because if you just look at the sideways pattern, you'll know that if you buy it for about 360, you might want to sell it for about 400, 420. If you want to risk it, you can wait for it to get all the way up to about 480. But by the looks of it, a lot of selling is occurring in the region of about 420. But this is once again a really good example of a sideways pattern occurring within Sasol, and it's happening between specific levels. It's actually so specific that if you buy it at 360, if you did buy it the other day, which was on the 21st of June, you would already be in the money, and you would be able to sell it when it gets to about 400 and, well, let's say between 415 up to about 420 would be a good selling position, just based upon this technical analysis that we're looking at here. Another good example of a double top, you'll see Sasol once again. If you see a double top or a triple top happening in a share, it is about to follow with a negativity in the share price. Sasol, once again, in 2014, forming a beautiful double top, and that was followed by a strong downward trend in share prices. So do watch out for those double tops and those double bottoms. Then I want to show you on Sasol, still, in 2008, there was a really good example of a head and shoulders pattern that emerged. Now, head and shoulder patterns are really hard to spot on shares, but if you do spot them, they are really good examples of what you can expect to happen next. Now, if you see a normal head and shoulder pattern as what I'm showing to you here, you'll see the left shoulder, you'll see the head, and that is followed by the right shoulder. This is a normal head and shoulders pattern. If you see something like this, then you can expect share prices to go down. Now, if you see the inverse, which means that your head is not here at the top, but the head is actually at the bottom, so this point that you're seeing over here would normally be here at the bottom. The left shoulder would still be the left shoulder, and the right shoulder, the right shoulder. But if you see the inverse head and shoulder pattern form, that's a really good indication of share prices that are about to explode and basically continue with the rally upwards. So that's something also to watch out for. I know it's a little bit hard to spot. You don't see them that much these days, but head and shoulder pattern formations are really good examples of what you can expect to happen within a particular stock. I did get a question that did come through to ask what is the difference between the saucer top and a sideways pattern. Now, normally with a saucer tops are not really sideways patterns. There are a slight difference. So let's get back to the saucer top so that I can show that to you. Let's just get back to the example where we had the saucer top. So let me get it S&H. Right, so this is a good example of a sideways pattern. Now, the difference between the saucer top and the sideways pattern is that your sideways patterns will normally move for a long or an extended period of time between two certain price levels. A saucer top, on the other hand, will not do that. A saucer top will gradually lose momentum as it reaches its peak, right? And as it reaches that peak, let's just get back to the saucer top example. Here we go. So you can see with Kumba, although it seems to you like it is moving in a slight sideways pattern, you'll see since 2010, it started to lose momentum as it gradually starts to make new highs, but it's very small increments as it moves. And as it moves up, it gets to a certain point, and only for a slight period in time does the share price move in a sideways pattern before it actually breaks down and continues to move down. Now, the difference between the saucer top and your sideways pattern is in the breakout or the breakdown of the share. You'll notice that even if you do see a sideways pattern which you think is the same as the saucer top, you'll see the saucer top has a gradual decline in share prices as it moves down. Whereas with the example of a breakout, as soon as the share price breaks above the sideways pattern's resistance level, it will normally be followed by a strong and sudden upwards or downwards movement in the share price. I hope that answered your question. If you can just let me know if that was what you're looking for. So the main difference between the saucer top is almost the pace at which the share prices move. So the saucer top will gradually lose momentum over time, whereas the sideways pattern is normally followed by a strong, either a breakout or a break below the support level, which is quite rapid. It's not something that happens over a period of time. It's normally something that quickly happens within the share price. So I hope you have a little bit of a better understanding between the two. Okay, cool. Thank you very much for letting me know that it does answer your question. So right, so I'm just going to mention the few things that you can look at. I'm going to end this webinar by saying, remember, please do go and read the lecture modules. I want to refer you back to lecture number 4 under the technical modules, which talks a little bit about the trend lines and formations like we spoke about this afternoon. But I want you to go and do a little bit of self-study. But please go and read up. And we said this afternoon we touched on a few things. And the few things that we did touch on was the bull trends, the bear trends. And remember, you can look at those type of trends by using a moving average line. Then we spoke about breakouts, which occur with sideways patterns, channels, double tops, double bottoms, head and shoulder patterns, reverse head and shoulder patterns. Then we also get V tops and V bottoms. Then we also get saucer tops and saucer bottoms. Then we get things like triangles, flags, pennants, and wedges as well. Now, all of these are a lot of things to take in, but I want you to please go and do some self-study. We have a whole lecture on this as well. Please do watch the webinar, which is included in the lecture module, so that you get a better understanding of how things work on these things. Should you have any questions, please do not hesitate to phone the support guys immediately. You can phone us on 012 940 0800, just that number again, 012 940 0800, or you can alternatively phone us on our after hours number, which is 082 781 9885. Just that number again, 082 781 9885. From my side, Corneille, thank you very much for joining us for this afternoon's webinar. Remember to register for tomorrow's webinar, where we're going to be talking about selecting a stockbroker and the things that are involved with selecting a stockbroker. And then also remember to register for Friday's market analysis, where we'll take a look at what's been happening in the markets for the past few weeks and giving you a little bit of feedback for those things. Thank you very much for joining us. Up until tomorrow. Bye-bye.